We believe that size is not the enemy of returns and is actually a competitive advantage.
We think we can go in there, buy a majority stake in it and start operationally improving things.
Good news is when you have a great partner that is adding value every day, they're actually generating a higher total return over time.
I think it's important just to level set and provide some context for your subsequent comments. Maybe just provide a brief overview of your respective businesses and really focus on what is the opportunity set or the area of the marketplace that you guys are solving for. So Jack, please get us started.
Yeah, thanks, Clark, and thanks for having us here today. It's great to be here. As you said, I'm Jack Howell. I'm co-president of Stonepeak. We are an infrastructure private equity firm. We manage just over $72 billion in capital. We got started back in 2011. We've grown quite a bit since then. We focus on three key sectors, so energy, transportation, and digital infrastructure. I think within the infrastructure sub-market, we tend to look for situations where there's some sort of dislocation, distress, or an operational issue that we think we can go into a business and fix over time. And so I think we've done a good job of that over time and have grown the business. Obviously, a lot going on in each of those three subsectors, which I expect we'll probably talk about here in a little bit. But anyways, that's Stonepeak.
And Michael, please.
Well, good afternoon, early evening, everyone, and thank you, Clark. Thank you, Jack, for coming and participating in this with me, and thanks for having me and the whole CAS team. I'm absolutely humbled by what this last hour and a half has been. I've spent my entire career doing GP stakes. The first project I worked on at Lehman Brothers 24 years ago in 2001 was a GP stake of a London-based asset manager, and it was a $20 million ticket, and I didn't know if there would ever be another GP stake ever done. And to look out and see that GP stakes has become an asset class. There are multiple ways to play it. There are multiple competitors, and there are roomfuls of people that have a degree of interest in it, and firms like CAS that have really dedicated themselves as one of their main themes to this subsector of the industry. It's just absolutely amazing to me, and I'm truly humbled by it. The Blue Owl business is sort of the largest in the space. We have a market share of about 66% of all GP stake assets ever raised. Across my career, I've done over 100 transactions, and those firms have a total enterprise value of close to $400 billion. So this is all I do, and it's a fantastic job. I get to partner with people like Jack and firms like Stonepeak, and it's been an amazing run, and I think our results would show that. Everything that's been described over the last hour rings true, whether you're talking about an early stage graphene business, a Bonaccord business, or where we like to play at the larger end of the spectrum. These are just great businesses in a great industry, and we see a lot of future growth and success. So thank you all. I see so many faces of existing clients. Thank you all for your partnership. The CAS organization is the leading client in GP stakes. They know it the best. They have the broadest reach. And as Christopher alluded to, you get a unique way to invest in GP stakes through CAS that you really don't get if you come to any of us individually. So they've created an amazing mousetrap that is truly unique and very well suited to individual investors and RIA partners. So,
thanks, guys. So Jack, for you, beyond just financial capital, right? What was it that a GP stake provided to Stonepeak to allow you to do what you guys do, either better, faster, or with more efficiency than you guys would have been able to accomplish on your own otherwise?
Yeah, it's a good question. I'd say we were in a pretty unique position at the time. So this was early 2022. I was having lunch with my two partners, Mike and Luke, and it was a pretty bleak fundraising market at the time, I'd say. And we were also at a point in the firm where we'd gone from having one flagship product to having 7 different products. Now, other than the flagship fund, the other 6 of those products were on their first iteration, which is a tough place to be when you don't have any balance sheet to kind of seed assets and grow teams and things like that. And so, I think we looked at the world and said, look, we'd love to get some capital on the balance sheet. Just gives us more flexibility to kind of grow these things and get the growth on kind of the right trajectory that we wanted. And so, that was kind of the initial discussion. We'd been approached to do GP stakes over time and had kind of pushed off the idea. We just didn't feel like we were at the right, size of the firm to do that. And anyways, that's what kind of kicked off the discussions.
How long was that process, right? Because, some of these transactions, they can be multi-year negotiations. Was this something you guys made the decision on and knew you wanted to move on quickly, or did it take some work with your partners?
I'd say it was pretty efficient. Within, I think we closed the summer of, with Blue Owl, we closed the summer of 2022, so call it a 6-month process.
Yeah, and then Michael,
if you don't count the 5 years that I called on you guys,
Yeah, that's
you wouldn't return my phone call.
I wasn't going to name names on who called on us, but yeah.
Hence my prior statement, right? So related to that, during that diligence process, Michael, what was it for you that stood out about Stonepeak that was either something that was a pleasant surprise you didn't necessarily know about before, but what really resonated to say, like, I want those guys?
Well, that's probably the biggest layup question you could ask. What our strategy is, we believe that this industry, it will grow, it will double over the next 5 years, and it will go through the normal maturation and institutionalization that a lot of industries go through, and that the top, call it 200 players in the industry will take market share. You heard Grafine say earlier, about 2/3 of all the capital raised went to the largest funds in the industry. And so that is playing out. And so that's been our strategy all along. And so, as we sat back and continuously sit back and look at who are the best brands in their respective space that we would absolutely just love to partner with, in infrastructure, Stonepeak is at the top of that list. So you're just hoping and praying that the phone rings one day and they say they will take the meeting finally, and that there's a chance to do something. So when you peel back the onion and look at what Stonepeak is, it is one of the category killers. It will be one of the largest players in the infrastructure space, which will give it the resources, reach, and scale to truly be a dominant player. It's like getting a phone call that the Cowboys are for sale. Sorry, I don't want to offend anybody, but you don't think twice if you get that phone call. And everything that was found during diligence was, again, a complete layup. This is a fantastic organization. They're big already, but they have ambitions to be a true category killer, and so it was an easy one for us.
All right, so Jack, your turn, right? You guys are a blue chip name. Obviously, you had your pick of the litter, so to speak. What was it about Blue Owl and Michael and his team that made you say those are the partners for us?
Yeah. As I said, my 2 partners, Mike and Luke, we've got a great relationship. We're good friends. We travel together, our families together, all that kind of thing. And we obviously want a partner that fit from a cultural perspective. Michael and his team were great to work with, and we kind of saw through the diligence process, and we only talked to a couple folks, but we kind of saw through the diligence process who we thought would kind of fit into the Stonepeak culture. We thought they obviously checked that box. They're obviously the largest, and they could write the biggest check as well to kind of help us grow these businesses that I mentioned. And then one item that was probably lower on our list when we did the deal, but has grown on our list since we did the deal, was just kind of the support that they have. They've got a business services group, and they've helped us from everything from finding CEO candidates for new companies to HR decisions at the Stonepeak level, and honestly, it's just been a game changer. And we've now we actually recently today we announced we closed on the acquisition of a small credit manager that's adjacent to one of our sectors. All the M&A stuff that we went through on that front, the Blue Owl team helped us there. So I would say it was probably number 3 on the list when we did the deal, but it's probably close to number 1 at this point. I mean, we've got constant dialogue, and it's really become a situation where they've become more than just a capital partner and more than an investor, but we kind of view them as hand in hand with us in growing the business.
Yeah. So you touched on this, Michael, go ahead.
Well, I was just going to say, that wasn't part of the original business plan when Stake started. And so when we really launched the space 20 years ago, the strategic aspect wasn't even talked about. But when we really kicked off and launched the business in 2009 under the Neuberger Berman Dial brand, we really wanted it to be strategic. We wanted there to be assistance. The original partners wanted us to stay as far away as possible. Now we thought if we put together a really interesting team, organizations are going to want to make this more strategic, and we think we can be value additive. So it was great to hear the last 2 panels talking about the strategic side of it, because it has become more than just a financial asset class. It really is a strategic one. With our scale, we're fortunate enough to have 65 people that are just dedicated to helping our partners every day. So it's been also humbling to see how the strategic side of this industry has developed over the last 10, 15 years.
So Mate, you touched on this earlier in your prior comments, but when you think about just infrastructure as a whole, what kind of tailwinds or emerging markets are kind of front and center for you guys right now, in the sense that it gives you that confidence for growth of the space? And is there any particular area within infrastructure that you might feel is overcrowded, or maybe something that you guys are looking to avoid?
Yeah, look, I mean, I think one area that's kind of exploded, just going back to Fund 1 when we were investing that, we've always done 3 sectors, so energy, transportation, digital infrastructure. So we were doing data centers and fiber businesses and everything back in Fund 1, cell phone towers, stuff like that. A lot of our competitors at the time kind of threw that to the side and said, well, that's not really infrastructure. Infrastructure is transportation and energy assets. And so I'd say we were earlier into that sector. At the time, that was fantastic, because you could go buy cell phone towers at low double-digit multiples. You could build them at single-digit multiples. There was less capital competition. We sold a tower company, 18 months ago for 45 times cash flow. Like it exploded because all this capital came to the space and it got more competitive. So I would say we're continuing to invest in digital infrastructure. We think probably within the 3 subsectors, it's got some of the best tailwinds. But we do look at things like capital flows and where people are putting money in. So I do think you got to be conscious of where you're investing within those subsectors, making sure you're doing the right deals. Not every data center is created equal, things like that. So that's probably something I think the market is, I don't want to say too bullish on, because again, the tailwinds are great. But when too much, it doesn't matter how good the tailwinds are. If too much capital flows into the space, prices get bid to a level that don't make sense. It makes it tough. And I think, the one thing maybe I didn't mention is we're incredibly focused on downside protection. You sit in one of our investment committee meetings, 75, 80% of the time is spent on the downside case. How do we lose money on this deal? And so again, when prices just get inflated, it gets tougher and tougher to make that case.
Sounds familiar, yeah. So let's go back to the GP stake specifically for a moment. So obviously, anytime there is a relationship or partnership, I think everyone's always got really good intentions going into it, but sometimes things get complicated. So when you think about, from each of your positions in this relationship, what is kind of the biggest challenge, and how do you guys talk about that and address it together? So Michael, why don't you go first?
I don't want to dodge the question, but there really hasn't been much friction of any kind. We don't really see that very often across our partner group. The diligence up front, knowing that we have a meeting of the minds about what the partnership's going to be about, and we're going to dive in and try to be helpful if we can, and it's up to our partners like Stonepeak to decide how much of us they want to see. Stonepeak does thankfully want to see us around a lot, and most of our partners do, but we're there to be helpful. And the relationship has gone great. I think across our portfolio, we are looking at the exit environment, and that's a big part of underwriting. The good news is that we've underestimated our partners' ability to generate great returns, and we've underestimated their ability to raise nice big funds. But we've perhaps been a little too bullish on the pace at which people could sell stuff. Now, some of that was out of a lot of our partners' control, and Stonepeak would be a good example. We all have gone through a lot over the last 4 years, from COVID to rates to whatever you want to blame on it. But the only thing that is, and it's not a problem, it's just the only thing that's not tracking as we would have hoped across our whole portfolio is the pace of some of these monetizations. And the good news is when you have a great partner that is adding value every day, they're actually generating a higher total return over time, even if it takes longer. So, that's the only, I wouldn't even call it a challenge. It's the only thing that is a little bit different from underwriting to actual, that, we're likely to see better outcomes just on a longer time.
Yeah, look, I think it's a fair point, right? Challenges don't have to be problems. Sometimes those are good challenges, right? And Jack, what about from your perspective? Anything you'd add on top of that or different?
Yeah, look, I mean, the relationship's been great. I think where it could go off the rails, again, hasn't been an issue at all with Blue Owl, is if you have kind of a different vision for the business. But I think when we did the deal, we kind of laid out our 5 and 10 year plans for where we wanted to go with Stonepeak. We kind of held hands with Blue Owl and agreed that was the plan. And those are going to shift over time. And but again, it's a real partnership. Like when we, this credit manager that we acquired, we spent a lot of time with these guys asking, what do you think about this? Are there other guys we should consider? And so it's quite collaborative. And so again, I just don't see it getting off kilter, just given the relationship there.
Yeah, and so Michael, you touched on this, that you guys are in frequent communication. Not all firms want to be, communicated with that same degree of frequency or magnitude. But as you monitor all of the different businesses inside the portfolio companies inside the fund, how much communication do you have? What are kind of the key metrics that you guys focus on for tracking them at the company level, and then how do you evaluate yourself, right? Like, how do you know you're adding value to them, and how do you guys think about that?
Yeah, we just, and I'll say it briefly because it's not overly unique, but we've divided our business into 3 distinct teams. One team that is only responsible for adding value, and they're out there working at all levels of our partners' organizations. And Jack mentioned a few areas, but we have a team of data scientists. We have an HR and compensation team. We have a procurement team. But we have all kinds of different areas where we plug into the organization. And the best part of my day is when I find out that there are people traveling all across our partner group and I don't know anything about it. It's sort of a wholly contained group. We monitor them on how much value we're adding and what the partner feedback is. We have a separate team that's quite large that all it does is monitor the financials. We sit atop $2.1 trillion of underlying AUM. So 1/6 of the industry, we own a piece of their company. So we are utilizing that to really hone a lot of data, pull it together and be able to work with clients to better understand what's going on in the private market. So we have a whole data team and monitoring team that's focused on that. And then my senior team and on the investment side, we really connect with the top of the house and spend time with the founders and the ownership group talking about the vision for the business and what the key issues are. But at our scale, with over 120 people just dedicated to GP stakes at Blue Owl, we can have very large teams that do this in a very bespoke way.
Perfect. And then how do you guys measure yourselves specifically, right? Are there key metrics that you guys think about, post-transaction, or how do you guys think about that?
Well, I mean, there are a lot of bottom up and bubble up ways that we evaluate ourselves. But what we care about is, are we doing a good job for you, our clients? What our real metric is what are our returns look like? And yeah, you can talk about IRRs and you can talk about holding value, but we care about how much cash we get back into our clients' pockets. And for every quarter that all of our private markets funds have been around, they've been top quartile DPI funds. From the very first quarter all the way through today, we have funds that are 10 years old. We have funds that are 2 years old. And in every case, we're a top quartile DPI payer because we believe the best way to generate returns for clients is to get your money back to you. For every dollar we give you, we want to be giving as much back immediately as possible. And that's a hallmark of a lot of the stake strategies, but certainly ours and the main metric we focus on.
And then Jack, for you, I'm curious, given there are so many different areas within infrastructure to play, whether it's bridges, cold storage, et cetera, and you mentioned digital assets a little bit, how do you guys think about the asset allocation dialogue at your level, and how do you bifurcate or trifurcate that time across those three verticals and just, decide how to spend that?
Yeah. So we're pretty agnostic to which vertical we invest in at any given time. I think we see enough deal flow out of each sector that we kind of know what's going on in each sector, and then obviously the subsectors that they're in. But we like to find situations where I mentioned where there's some sort of dislocation or, again, an operational challenge at a business. Like if a deal comes to our investment committee and it's an auction process and it's, hey, this thing is going to go to the highest bidder and it's a cost of capital shootout, like that kind of thing gets kind of laughed out of the room. There needs to be some edge or angle to the deal. If you look at our track record, our best deals have been situations where, we've done a carve out of a company that's financially distressed, or we provided preferred capital to a, near bankrupt energy company or something like that, where, again, it keeps a lot of the capital away. And then on the operational side, one of the things we like is, and again, it's getting more and more competitive, but infrastructure's typically been a pretty sleepy industry, and a lot of the businesses are monopolistic in nature, and they tend to be run like monopolies oftentimes, where there's a lot more juice to squeeze out of the business. And so we love finding a business, oftentimes a family-owned business that we think we can go in there, buy a majority stake in it and start operationally improving things and generating better cash flows and revenues, and creating a better barrier to entry into that subsector or whatever it is. And so those are the things we like, and I think it depends on whatever's going on in those markets. For example, we did a lot of energy deals during COVID because everybody had thrown fossil fuels out, and we were buying gas pipelines and gas processing plants and things like that for incredibly attractive prices that
Has it changed that much since?
That subsector?
Yeah.
I think it's been a great ride since 2020 in the energy sector, but it's become a lot more competitive because a lot more capital has moved back into the space and things like that. So again, we kind of hop around to different sectors depending on what's going on from kind of a macro perspective, and then, as I mentioned, a micro perspective as well if it's a specific company issue.
So
real quick on that, in a complete plug for Stonepeak, a lot has been said over the last hour about different size companies and where you want to play, and there were some very good cases made for middle market buyout or even early stage managers, and they were all very well said. One of the things as we think about infrastructure, and we feel the same about private credit, but in particular infrastructure, we believe that size is not the enemy of returns and is actually a competitive advantage. It's hard to be a small sort of domestic infrastructure firm and see everything that a Stonepeak gets to see. And to learn from the global footprint and a global client base and opportunities in so many different subsectors, you need scale, and that's why they've generated the kind of returns that they have, and that's why I think the growth has been so strong, and clients love you guys. So the scale is very helpful.
So Michael, something we've spoken about before is just GP stakes as a whole is much less nascent today than it was certainly when you guys entered the space and kind of created the asset class, a decade or more ago. But even today, for a lot of folks, they still don't really understand it overly well or know it. So what's one thing, if you had to leave everyone here with today, that maybe is a little bit misunderstood that you want to clear the air on, or maybe a misconception about the space that you think is very important for everybody to know?
Yeah, like on your Instagram, it always pops up and it says you will spend, 29 years of your life sleeping, or 4% of your life brushing your teeth. I don't know who brushes their teeth that much, but anyhow, I will spend some ridiculous percentage of my life talking about the exit, because the sort of the blessing and the curse of GP Stakes is that when we buy a partnership with a Stonepeak, it's not for a finite time, and we don't ever expect to exit. We hope that we own a piece of Stonepeak and are partnered with, the team that succeeds Jack and Mike and Luke, after they retire. That's our view, and to own this cash flow stream for a very long time. That's the blessing of the industry. The curse is that some of you want your money back at some point. And so have spent a lot of time over the last 15 years, and will continue to, showing clients that there are a lot of tools in our toolkit to ultimately get a client an exit if they want. It doesn't mean we're going to break our relationship with Stonepeak, but we have other ways that we can get clients out. The good news is, we've been doing it long enough that now we have a whole list of examples where we've provided exit capital. A number of our partners have gone public. A number of them have sold. HPS just sold itself to BlackRock for $13 billion. And we've started now selling slices of our older funds to a new group of investors that wants to come in for the next leg of the journey, starting to give capital return back to investors over time. So, I think that's always been the issue for the industry. People like the strategy, they like the cash flow, and it's why GP Stakes has taken off. But, the reason why it is a little bit misunderstood is just this question, this looming question: can I ever get out? And now, fortunately, knock on blue canvas or whatever this is, we're showing.
There's a table next to you.
Yeah,
that's helpful. There you go.
We can do it, and we will do it. So hopefully the percentage of my life talking about exit will go down. But it's certainly accumulated a lot.
Yeah, I know the other one that pops up frequently, because we hear it all the time too, and it's because people don't know where it fits in an asset allocation conversation, right? So sometimes you have to think more about the attributes of the investment, not necessarily what it's called, right? And because of that cash flow nature, et cetera, I mean, it's chameleon-like, right? It can live in a lot of different buckets. So maybe just touch on that briefly.
Yeah, the good news is that for a lot of you, hopefully, bucketing isn't a big deal. We've gotten thrown out of many state capitals where their pension plan says, we don't know where to put you. And so, I think that was a very big problem early on, because it is yielding like a credit instrument. It has long-term upside like buyout. It has some secondary components to it, because there's a lot of assets in the ground that will come out early. So people had a hard time bucketing it, and it was an easy way to say no. And a lot of big pension funds used that opportunity to tell us no. We got way more no's than yeses, for sure. But now with this much history behind us and the returns that we've been able to generate as an industry, I think people are willing to say, you know what? I'm not sure exactly what bucket it goes in. I can put it in a lot of different places. I just know I want it in my portfolio.
Super helpful. So there is not much sand left in the hourglass here. So really quickly on this, you both obviously bring a lot of unique experiences to this collaboration, right? What's one lesson that you would say you would take from your career that you've been able to bring forward that's allowed this partnership to just blossom and be as successful as it's been?
I mean, I think it goes back to what I said earlier, is making sure you've kind of got a game plan, and then holding hands what that game plan is going to be and going and executing. I mean, we try to do that with our portfolio company CEOs when we buy a company, or we start a new company or invest in an asset, and trying to hold yourself to that plan, and if things start going off that game plan, get it back on the game plan. And I think that's worked well here in this partnership, and we couldn't be happier with the setup. So,
great. Michael?
Yeah, briefly, we were talking just before we came on about a different topic, but it came up. What's the difference between IQ and EQ, and can you have a spread between the two of them? And look, I purpose-built the Blue Owl organization to be extremely high EQ, maybe at the expense of IQ. A lot of us are good old boys from Pittsburgh, and we don't have a ton of Ivy League degrees on the wall, but we knew that this was going to be a relationship industry and that people were going to pick us because we're going to be long-term partners and we're going to be the people that you want to work with. And I think that was probably, I don't know if I got lucky or maybe nobody from Harvard wanted to work with us, and so I self-selected only kids from Pittsburgh. But that was something that in the rearview mirror looks like a very smart decision, and I guess I'll take a little credit for it.
You deserve it.